everyone. Thanks for joining us for another DeFi Raiders AMA. I'm Degenic, and today we're here with Arcadia Finance, who provide on-chain margin accounts that can be used to trade on your favorite DEX. Super excited to talk to you guys. Thanks for joining.
Yeah, likewise. For those that margin accounts still sound a bit abstract, happy to dive into it, what it actually means for users, and thanks for having us.
Yeah, absolutely. Looking forward to get into it. So before we get into the protocol itself, I'd love to just talk for you guys to talk a little bit about yourselves and and how you all came together, and if there's more team members that aren't with us, just kind of run us through who all is involved and how you came together would be great.
Yeah, sounds good. I will pick that up. For me, blockchain, I've been around in the space for quite some time already. Initially did some very small scale Bitcoin mining back in 2011. Unfortunately, I wasn't the big visionary back then, so I sold most of my stake in the years after. But I did see like the rise of ETH as well, and how was those chains as they came to be. And then from 2016, I started to do a couple blockchain developments. Also was then at the time joined by Thomas, a long-time friend of mine. We built all kind of arbitrage bots at the time on centralized exchanges. Thought it was pretty cool. Didn't make a lot of money though, because at the time, probably those centralized exchanges, they did quite a bit of the arbitrage themselves. But then anyway, when DeFi really started to come up, that was for myself and for Thomas the time that we started to do a very deep dive into everything smart contract related, everything Solidity, everything EVM related. We made a number of MEV bots before they were called MEV bots. So we did both the high frequency arbitrage strategy, but also the more one-of-one strategies. Did that for a bit and really saw the ins and outs of DeFi, all the blue chip DeFi protocols. We read through the contract of many shit protocols as well. And then started to notice a couple of things missing in the space, some things lacking. And then early January in 2022, so a little over a year now, then decided to just go full time with Arcadia Finance. At the time, I also got into contact with Jose. Jose actually was initially, let's say, on the other side of the table with one of our first investors. But then later on in the year, he switched teams. Maybe Jose or Thomas, if you want to add a couple of things about yourself as well. And then we can also quickly say something about the rest of the team.
Yeah, I'll just quickly follow up. Thanks for having us, by the way. Excited to do this. So my background is a little bit different. So after university, so I tried to build a company of my own unsuccessfully, but did learn a lot. And then after that experience, I decided to join a early stage startup in Berlin. That went really well. So I joined early in their Series A. They ended up raising 2 more rounds, became a unicorn in the process, and so saw kind of the entire life cycle of a startup from like the very early stages to hyper growth and so on. And then after that, ended up joining a VC firm in Berlin as well, where I led crypto for them. And so I was tasked, by to like build a team from scratch, source the first investments, got very deep into the space, learned a lot about it. And that's where I got to meet Thomas and Jasper. And we ended up leading their pre-seed round last year. And so I've been really working with them for the past year, kind of behind the scenes, helping them out with all business related tasks. And recently, kind of realized, I'm really wasting my time being a VC. I personally do not think like VCs have like a role to play in this ecosystem. I think it's really more hands-on. It's really more like very different actually to where a traditional VC works. And so ended up switching sides, joined them full time, and really happy. I think that pretty much sums it up. Thomas, you want to follow up?
Yes, yes. I think it's my turn still. So my story actually pretty similar as Jasper's. I also know Jasper already since high school. We both studied engineering in Leuven. And then yeah, Jasper was already talking about crypto in 2016. So I was highly skeptical, thought he was investing all his money in a Ponzi. So I did some research to prove him wrong, but then actually the opposite happened. So quite soon I fell deep into the blockchain rabbit hole, did some small developments myself, joined some Belgian communities where I'm still active. And as Jasper said, soon we started building a couple of arbitrage bots. That was all on the side, so not full time. Um, During bear market 2019, also decided that I wanted to work already full time with blockchain. So joined in Belgium a company, Intellect.eu, that builds decentralized applications, but more for the traditional financial institutions. That was more with the permission private blockchain. So learned a ton how finance actually works. But unfortunately, it was mostly proof of concepts. And yeah, I'm a bit impatient, so it went too slow for me. So then I'm very happy that on the side, Jasper and I built our MEV bots. Um, there really saw the beauty and the power of DeFi. So things as composability, concepts as flash loans, a fully open permissionless financial system. So really fell in love with DeFi, but we also saw some of the shortcomings. And then we decided that we both wanted to work full time with blockchain and actually start building. So then we started Arcadia Finance. That was around December 21, January 22. So then we founded the company, got our pre-seed, met Jose there. And then, yeah, in the meanwhile, grew the team. So we're currently with 5. So apart from Jasper and Jose here in the call, we also have Simon, very, very good developer who can do everything from Solidity to backend to front end. And Zeki, who is leading our product design, product development, and also is specialized in building out risk models. So it's a data scientist that's worked on risk models in the past and now also first does the risk models. So that's a bit the team. Yeah, I think that's it from my side.
Ah, very cool. Thank you for that. And I love the diversity of backgrounds that you all bring to the table. So now tell us how did you guys decide on on-chain margin accounts as the problem to solve?
Yeah. I think it also leads back to our previous activities with making MEV bots. So when we were making all of these bots, these new strategies, you have to know these MEV strategies, certainly back in the time, they weren't, let's say, continuous strategies, especially not the ones that we target. We were always looking for new chains, new protocols, as exotic as possible. And it was always a way of working that we found a new strategy, could run it for 1, maybe 2, 3 weeks. Then the competition came in, became a gas war, because often in those times, things like Flashbot didn't exist yet. And then so after a couple of weeks, you had to go to the next strategy, find it, be the first there, and then run it again for a couple of weeks. So even though it was just a very interesting space to build on, it was not something that we saw as something sustainable for us. I think both Thomas and I, we really wanted to build something with, say, added value to the ecosystem, and building MEV bots. Although we didn't do the actual negative MEV, it's still not really value adding to the blockchain world. And so while building those bots, we also encountered many things that were just not either not there or just not as efficient as we thought they could be. If you give you a couple examples, for example, for our MEV bots, we worked a lot with leveraged positions. We had collateral locked up on a number of other DeFi protocols. And each of those collateralized positions were all isolated from each other. So even if your ETH went down, but your Bitcoin went up, and they were in 2 different protocols, you still had to top up your ETH, for example, even though it should have been compensated by Bitcoin going up. So all of those collateral was just scattered across DeFi, and the losers were not getting compensated by the winners. And then on the other hand, we as smart contract developers, we saw the magic of DeFi, really that composability, that those flash loans, for example. So really what we see as the magic of DeFi. And that just wasn't there for, let's say, the average user. So it's those points that we really wanted to combine in Arcadia Finance. So really margin accounts where the collateral is managed in a way better, more capital efficient manner, where you can just deposit multiple assets together that losers will compensate or get compensated by winners. And that we actually have offered those concepts of flash loans, of flash withdrawals, of optimistic transactions to our end user through our own DEP.
Fascinating. So tell us a little more about this. The margin accounts are represented as ERC 721 NFTs, so they're tradable. But then within them they can have a variety of assets that you're supporting price feeds for all of, but they can also have positions, right? Like an AVA token. So how, tell us a little more about how this works, please.
Yeah, sure. So the margin accounts, those are really separate smart contracts per user. So every user of Arcadia Finance has their own margin account, their own smart contract, and those are actually per user. So an ERC 721, so that the margin accounts are, let's say, already composable with all the existing infrastructure. The margin accounts, they have like two big sides. So one hand, you have the equity, so the assets within the margin accounts, those are the assets you own. There we can allow users to deposit a whole range of assets together. So you can really deposit all your assets within your Arcadia margin account. And then we price the total value of all those assets in a single base currency. So for instance, you deposit your C20 tokens, like some Uniswap, some Link. You deposit even some DeFi primitives like Uniswap V3, and at some point maybe your NFTs. And then for each of those, we can price the individual asset, and as such also the complete portfolio in that margin account. So for instance, we can say on chain that you as a user have, let's say, $20,000 worth of assets in your margin account. And then you can use that same equity, so the value of all those assets, to take debt, so to take liabilities against. And as such, your margin account will guarantee, for instance, that if you have 20,000 of assets in your account, that you can maximally take 15,000 in debt. So if you look at it at a real abstract way, you can almost think of it as a smart wallet, where next to the assets you already have, you can also use debt to interact in a permissionless way with the rest of DeFi. So it has a lot of use cases, but from a step back, you can really compare it as you have your MetaMask wallet. Normally, you're only limited to use the assets that are in your wallet. But with Arcadia Finance, with our margin accounts, you can also use debt. So you can, on credit, build leverage positions, hedge positions. And in the future, it will be much broader than debt. It will be any smart contract that works with counterparty risks. So where there are liabilities between one user, another user, or one user in a smart contract, they can use their Arcadia margin account to manage those counterparty risks. So on a margin account level, the contract ensures that the user always has more equity than they have open positions. So might all sound a bit abstract there. What are some concrete use cases that you can do as a user? One example is truly leveraged trading on any DEX. So that's also the first use case that we have live now. So here as a user, you deposit some assets in your margin account, and then you can use both the assets you deposit as borrowed assets to, in a permissionless way, use any DEX on that protocol. So we, for instance, through our own DApp route via 1inch, so that guarantees that you can trade on leverage within DeFi with always the lowest slippage guaranteed. Next to that, other use cases might be to leverage farms, for instance. If you somewhere have some, let's say, staked ETH that has some nice yield, and you can borrow ETH in Arcadia at a lower yield, you can basically leverage up that position and increase the amount of ETH that you earn. So that's another example. And there are many more.
Fascinating. So, and you're also enabling flash withdrawals and flash loans so that people could rebalance a position, as Jasper mentioned a few minutes ago, right? You have a ETH on one side, Bitcoin on the other. Your ETH has gone up, your Bitcoin has gone down. So, would you walk us through how one would rebalance that via, without pulling the position?
Yeah, indeed. And then maybe one, before I do that, one more concept I have to explain here is that all of those assets, for example, that ETH and the Rep Bitcoin, they're all within that same margin account. And it's only the, let's say, the summed value of all your assets within your margin account that is really taken as the value of your margin account. So if you have ETH in your margin account and Rep Bitcoin in your margin account, just deposit as collateral assets. Then even if ETH would drop and Bitcoin would rise, your margin account would be equally healthy, given that they rise in the same amount of value. So there is even no rebalancing source if you have multiple assets within your margin account.
That makes sense. I described it wrong. So I'm thinking of a scenario where you have both borrowed against your, where you've deposited your Bitcoin and your ETH into AV, say, and borrowed against them, right? And you might want to extend a little more borrow on the ETH to repay some of the borrow against the BTC in subordinate positions. Does that make sense, or am I totally off track?
No, that indeed makes sense. Yeah, maybe indeed, like you walk me through how it would work, and maybe more explain about that permissionless way of interacting with other DeFi protocols. I think that will also clear up your question. So imagine you have a bit of ETH, of Rep Bitcoin, some other tokens, maybe a Uniswap V3LP token in your margin account. And you then have, let's say, a total value of 20K of assets within your margin account. You can then actually optimistically already take out additional debt. For example, let's say, let's take out another 20K in USDC in debt. So now you actually have 20K USDC and assets worth 20K USDC. And with that combined value, you can then do whatever you want within the DeFi ecosystem, all within a single atomic transaction. So it could be that, for example, you take all of the ETH from your margin account, you sell it to, for example, Rep staked ETH. With that USDC that you borrowed, you also buy Rep staked ETH, and then you deposit that Rep stake ETH that you just bought back in your margin account. There will be a final health check that's done, whether the open liabilities are covered by whatever is inside your margin account. And as such, you've actually done quite a complex DeFi interaction just with a single click through our app to, in this case, rebalance or take extra debt and sell some assets out of your margin account. So the rebalancing is really it's super flexible. If you can imagine it, then yeah, you can probably do it on our app as well.
Yeah, you can even automate it via keeper networks that you, for instance, say, if this happens, any keeper can rebalance my portfolio in such a way, and then it can all be automated. So if you compare that to, for instance, an Aave, there's completely different. If you want to rebalance your collateral, you have to start with rebalancing individual assets. It might not be swapped optimally, or you have to start with completely unwinding positions, swapping the underlying assets and retaking positions. With us, that's all not necessary. You can do it in the same way as a flash loan works, but you don't have to repay the exact same assets, just something of the same value at the end of the transaction.
Fascinating. And all the risk accrues to the individual user's margin account, right? So there's no concern with which DeFi protocols a user goes and uses. as with many of the many leverage protocols, right? Either only allow leverage within their protocol or within a very small walled garden.
No, exactly. So that's indeed different. Since we just force that the end state of the contract is in a healthy position, we actually don't care how the user does the intermediate routing through which protocols they go. So it's not that we have our own trading environment. Arcadia Finance is not a DEX, so we don't do our own orders or matching. We basically let a user with leveraged funds go through one or more other DeFi protocols. And since we just check on the end state that everything is healthy, we don't care through which other DeFi protocols that user went.
Yeah, very cool. So how, just to to kind of hammer it home, how is this different than a perpetual futures exchange, which seems like the most ready parallel?
Yeah, sure. So there are a couple of differences. I think the first one is something I just mentioned. So with the perpetual protocol, you have an isolated trading environment. So all the perpetuals are basically not the actual asset. You trade a derived contract of an underlying asset, but the perpetual of one per protocol is a different asset than the perp of a different protocol. So you're always isolated on a single exchange. Meaning that if you have a trade you want to do for a certain pair that is quite illiquid on that chain, that you have high slippage, or for instance, since we can go to any DEX, for a lot of trades, we actually don't go via one protocol, but the routing is, for instance, done 60% via one trading pool, 20% via a second trading pool, and the remaining 20% via third trading protocol. So since we are not isolated, often slippage is much lower. So that's a first difference. Two, it's really composable. So the assets that you have in your margin account, you can still actively manage them and use them. For instance, if you have ETH and USDC in your pool, or USDT and USDC, for instance, you can deposit them in a Curve pool and they start earning yield while they are being used as collateral. So you can really use the assets that you leveraged. So yeah, that's also a big difference with the per protocol, since there you don't have the actual asset. You have a contract that just has a price that's derived. Since with us, you really borrow the spot asset, the actual ERC20 token. If the tokens give yield or voting rights or airdrops, etc., you are still entitled to the full, let's say, yield or voting rights associated with that asset. So it's also different with a per protocol. I think those are already two. Maybe a third, there are also upsides of a per protocol. For instance, they can go in much higher leverage than we do. We can't go to 100x, but more to around 10x. If that's a good or a bad thing, I don't know. I think 100x is also too much for most traders. So I think it's for a different audience. For us, it's more people that want to leverage funds to take longer term big positions and still want to do something with underlying assets, or big persons that wants to build leveraged yielding strategies, or for market makers that want to do leveraged market making so that they leverage up the underlying LP tokens of, for instance, a Uniswap V3.
Oh, very cool. Yeah, lots of possibilities, lots of differentiation. So, and speaking of Uni V3, I've seen this one come up a couple times lately. I saw you'll enable limit orders via Uni V3 liquidity pools. Would you tell us how the user flow for doing that will be different through Arcadia versus through Uni's UI?
Yeah, indeed. If I were to ask you, if go now to app.uniswap.org and set a limit order for a certain market at a certain price, many of the people will probably say, how the hell do you do that? Is it even possible? So technically, it is indeed possible through Uniswap's UI, but it's quite complex. And so on Arcadia, it will just be very straightforward, single click. How it will work is you come to our tab, you have your trading screen open, you have an asset that you want to buy, either using new dApps or just using, or you can also just swap an already existing asset in your margin account. You say how much you want to buy of it, at what price point, and then you just hit click and send and buy, or set the limit order. And actually then in the backend, or let's say in the smart contract wise, we then do the more complex stuff, which is completely abstracted away from the user. So there we will take the asset that he wants to sell, put it into or buy, put it into a out of the money concentrated tick. So it's still within one asset. Also fire up a Gelato network job that to take away the LP again if the price is passed. And then that resulting LP is deposited again back in their margin accounts and really counts as collateral. So the standing limit order will still be counted towards the total value of your margin account. And as soon as then price moves either up or down, the price is hit, Gelato Network will withdraw your P token, it gets back into your margin account. And yeah, you have fulfilled a completely DeFi native on-chain trustless limit order. And for the users, it's just 2 clicks to say which assets at what price point.
Yeah, that I love, and I understand y'all have been working pretty hard on gas optimization for it as well, right?
Yeah, indeed. Yeah, gas optimizations, I think you can talk hours for it. I think we just have to go back a lot to our experiences as making MEV bots there in the space. Really, if you can save a couple gas by doing what you're doing, you can give that much higher of a gas fee, especially in the gas wars earlier on. So we have our fair share of experience in writing gas optimized solutions, gas optimized smart contracts. And it's definitely something that we'd always take into, say, very high regard, because it makes, of course, a large part of the user experience, especially on mainnet.
Yeah, very cool. And right, I mean, great, perfect background you guys have for really all of these DeFi Legos that you've described. So very cool. So now, so what are the different ways for users to participate in the protocol, other than of course opening a margin account?
Yeah, sure. So users can interact with our protocol in multiple ways, going from in a passive way to through our dApp. As third one is to really build integrations with us. So I'll go over each of them. So in the first way, we mostly discussed now the borrow side, and that users can borrow funds and use them in a permissionless way via their margin account. In the rest of DeFi, of course, those borrowed funds have to come from somewhere. So we also have a liquidity side. So users can permissionlessly provide liquidity in Arcadia Finance and earn some yield on their assets deposits in our liquidity pools. That liquidity is then used by borrowers that use it to use leverage with their margin account. That brings us to the borrowers. There, I think we already discussed a lot of use cases that you can do with Arcadia Finance. So smart contract-wise, all those use cases are already possible. We know that most users don't directly use smart contracts, but they interact with it through a dApp. So that's what we actually have built now, but will improve a lot over the coming months. So a first use case that users can do is, as mentioned, this margin trading. So you can go to our dApp, deposit some initial funds, and then select some assets you want to go long or short with. You will always have full custody of the assets. And as mentioned, the swaps themselves are executed via 1inch, so always with the lowest slippage possible. So that's a second way how you can interact if you want to trade. A third way is for those leveraged yield farming strategies. So via the same trading screen that we already mentioned to trade, you can also build those leveraged farming strategies. So an example is that you open a margin account, that you borrow ETH from our lending pool, and that you then build, let's say, a leveraged long Coinbase stake ETH or rep staked ETH position against borrowed ETH. So that's already out of the box possible today. We know for some users that's still a bit too complex. So we will develop in the coming weeks what we call one-click strategies, that you don't have to go through the trading screen, but that you can just select the amount you want and the leverage, and then in one click we will build for you through the front end a leveraged stake ETH against ETH position. So that's the second way. And then a third way you can integrate is really built on top of Arcadia Finance. And those strategies we discussed before, users can also build their own front ends for it and do it in a completely permissionless way. So if you find other DeFi strategies that other users can earn some additional yield or take some exposure that people want to, you can build your own front end for it. You can even charge own fees as builder, and then under the hood use Arcadia margin accounts. And then maybe a fourth way you can interact is as a other DeFi protocol builder, where users or other contracts have counterparty risks. They actually also can use Arcadia margin accounts under the hood. So really built on top of our margin accounts to outsource all the collateral management and risk management and just focus on their financial contract.
Fascinating. That is a lot of options. So let's talk a little bit more about lender or liquidity provider risk management. I understand you have two tranches, right, that you're separating the risk profiles into. So would you just tell us a little more about how you're handling risk distribution versus revenue distribution for those users?
Yeah. Go on, Jasper.
Yeah. All right. Indeed. So our on the LP side, our liquidity pools, they have two tranches. So each pool has two tranches, what we call the senior and the junior tranche. The senior tranche receives part of the interest payments that are paid by the borrowers to the liquidity providers. And the junior tranche also gets part of the interest payments paid by the borrowers, but they get an additional earning on top, being the fees earned through successful liquidations. So when a borrower has a certain margin account, he went, say, too high in leverage, then the market tanked to become an unhealthy margin account, which will get liquidated. And if there is any profit to be made by that liquidation, because the protocol charges a fee there, then the majority of that fee actually goes towards the junior tranche. So the junior tranche gets the upside of successful liquidations, but of course the junior tranche also gets, let's say, higher risk, because if the liquidation would be a bad liquidation where the auction of the assets wasn't able to cover all of the open liabilities, then it's also part of the juniors of the equity of the junior tranche that will be taken away to recover that bad debt. So the junior tranche, they share both in the upside as a downside as liquidations. Arcadia already had one liquidation there. Luckily, it was just a small one, but it was a very nice one to test out everything, and everything worked as expected. Liquidation contracts worked as expected. Auction went as expected. Our own liquidation and monitoring bots executed what needed to be executed. So in the liquidation part, it was already a nice check that we could already do this early on in the protocol phase. But yeah, that's a little bit about the split between the junior and the senior.
Yeah, very cool. So is there anything else we should cover on protocol architecture before we move on to security and governance and future? I think we might have lost Jasper.
Yeah, sorry, no,
there you are.
I did get an incoming call, but I thought I could just keep on going, but apparently blocked my my mic here. I'm not sure where I dropped off. If you can just say the last couple sentences or the last.
I think you had actually wrapped up what you were saying, and the call came in right as you were done. But then I asked a question, which was, is there anything else we should cover on protocol architecture before we move on to security, governance, and roadmap?
Yeah, I think there's maybe another concept that makes us quite unique for the margin accounts. So basically, the margin accounts for each user, they are upgradable, but only the owner of the margin account can upgrade the logic of their contract. So to go technically, actually each margin account is a proxy account, and there are different logic accounts for that margin account. And as a user that owns a margin account, you can, for instance, because we have new features or allow new token standards to be used as collateral, can choose to upgrade your margin account. But since the proxy remains the same, you don't have to close positions, you don't have to migrate assets, and even the contract address of your account remains the same. You just have access to new features. Why did we decide to build it that way? I think our margin accounts, they are token standard agnostic. We are real believers that DeFi will go mainstream and that a lot of assets next to the ERC20s we have now will come to chain that are a bit more complex. And here we think about bonds, for instance, or equities, stocks, or other types of loans and credit. And those will not all be according to the ERC20 standard. For bonds, we now already see some companies experimenting with it, like a Siemens. But bonds have like maturity dates, they have different coupons. So it will probably not be according to the ERC20 standard. It might be according to a standard we don't know yet. And we want to have an architecture where we can allow within the existing protocol to add those new types of assets also to margin accounts. So here we can write a new logic contract that also can handle the new token standards, and then users with an existing vault can upgrade to the new token standard. Our pricing modules also can handle new added assets, and from that point on, those new assets that are perfect to use as collateral can be used by all users that already have an existing margin account.
Oh, very cool. And this isn't a centralization risk because the core protocol contracts are still immutable, and these are our user opt-in upgrades, right?
Yes, indeed. Yeah, it are user opt-in upgrades. The only thing we can do as a protocol designer or developer is deploy a new logic contract. And then we can only say to users, you can now upgrade to this new contract, but we don't have the power to force users. You really see the margin accounts as wallets, they're user owned. All the assets in it are truly of the owner of the margin account. So we as a protocol cannot force people to do things. So there is zero centralization risk since it's opt-in way. We just can give new features to existing users without migrations.
Yeah, that sounds like a wonderful approach. I think. Yeah, clearly we're going to have more and different asset types to come. So yeah, I think that definitely is some of the future worth planning for. So
no, go on. Yeah.
Oh, so I was going to move on to the next question. So, I understand you've had two audits. Nevermind, who did Aave most notably, and Solidity Finance, who did Yuga Labs and DOPEX. And you've published a set of tests to your GitHub. So, would you just talk a little bit more about your approach to security and what your plans are moving forward as well?
Yeah, I'll take this one. We indeed have these audits now listed. So back in earlier last year, we did a first audit with Solidity Finance. Then later on, for our go live, next to our own, say more call it an internal audit, we also did one with Nevermind. The security for us is always, say, the top priority, especially if we are working with or building smart contracts that will hold other people's money. It's something that should always be on the top of our mind. There are a couple of things you can do to increase, let's say, the level of security that you build into your smart contracts. One is while building the smart contracts or while writing them or while making the architecture. draw on past experience, on past do's and don'ts that we have seen within the DeFi ecosystem. Make sure that you know all the best practices and probably beyond those best practices. Then once you have, let's say, a set of smart contracts developed, or actually you should start before it, you need to have a very, very well-covering test suite. So with Arcadia, we use the Foundry developer framework. I think we have one of the largest test suites written in Foundry. It's hundreds and hundreds and hundreds of tests in tens of thousands of lines of code. So it's really, really a very complete set of tests, both unit tests, but also more these scenario tests. And I think that's just already, let's say, a thing that you cannot skip on. The tests that we now have, as soon as we change just one line and the test fails, we know, okay, it would actually crash, or it would have some security implications about what we're doing now. So it's very important to have a very good code coverage. Maybe 100% is often seen as the best, but at least 99 point something, that should be at least in the code coverage. So next to having the right experience, building a lot of tests, then come the more formal reviews, as we talked about in the audits. There are a number of different ways how you could do an audit. You can either go with one party and have them audited. You can also do some more the competition style audits. We also have the solo auditors that are really coming up lately. We currently did the more formal audits with what we see our security partners. Then later on, setting now also up a public bug bounty. In the coming weeks or months, we might also have another open code competition that we're currently setting up and looking into it. And next to that, you also want to have more or less continuously monitoring of your smart contracts. There are a couple of very good partners in it. We also have it, let's say, in a lower, in a smaller stage internally. That's just monitoring your smart contracts and get notified if anything very weird happens. I think that's mostly on the smart contract side. But it's a continuous learning process. We all see how many hacks still happen within the DeFi space. Some are more sophisticated than others, but every hack, the first thing we do with the team is analyze it. What have we learned from it? Is it possible to be applicable on our smart contracts? And just really stay up to date with all the latest types of possible exploits that are out there.
I love it. That is a robust approach to security. There was and will be then a bug bounty program upcoming, and you also have an ongoing relationship with Nethermind, right?
Yeah, indeed. Yeah, and that's really been a very good one so far. So they started with us doing just a formal audit, really line by line, and going through it. Afterwards, also informed us of a couple, let's say, suggestions to set up this kind of monitoring of smart contracts. So really, even behind, next to that audit, they really continuously to advise us on best practices and things we can implement to reduce the risks even more.
Yeah, very cool. That is a thorough approach. And I went and looked in the GitHub. That is an impressive amount of tests.
Yeah,
so
a pain to write them, but once they were there, really, really, really useful.
Yeah, someday hopefully we'll move to formally verified languages for all our dApps, but we're not there yet. So I think we already have covered governance pretty well. So why don't we move on then to roadmap? So the dApp has been live since last week, if I recall correctly, but kind of in test mode with limited limited limits, limited amounts of lending and LPing. So would you please walk us through the launch and feature release timeline and how users will be able to participate at each stage?
Yeah, sure. So maybe first to mention the smart contracts that were audited and deployed is what we call Arcadia V1. So already much of the features that we mentioned are possible with that smart contract suite. But of course, as we spoke about a lot of use cases on our go live, we wanted to, I'd say, be very conservative with any possible risks. So we're really limited both the amount of assets that can be used, as the number of assets. So on our go live, we did actually together with Degen Score, so really DeFi OGs that know what they're working with, and with capped amounts. And then we first opened the borrowing pools only for USDC and wrapped ETH. And then a week later, we opened the borrowing side. And for our dApp, we already built the user interface that you can do margin trading. So there as well, with a limited number of assets, the most conservative blue chips like wrapped Bitcoin, like a Uni, wrapped ETH. So that's where we're now at actually. So now you can use our dApp and you can mainly use it to do margin trading. Coming weeks, we will add a lot of new types of assets that you can use as collateral that also enable new use cases. So the first one that we will add as collateral is Uni V3. That will allow us two things, or users two things to do. One, they can use in our trading interface also limit orders now. And two, for the more institutional players, market makers, they can do leverage being with Uniswap V3. After that, we will add the liquid staking tokens as collateral. So then a lot more yield farming strategies will be possible for users. We will also build a special page on our dApp to make it easy for users to go in such a strategy. So via one click that you can choose a certain strategy and take a leverage position. And then over the next weeks, we will build the pricing logic for more collateral assets that we will all add to the existing protocol. And as such, with our Arcadia V1, already give a broad range of use cases to users. So that's all already possible from our smart contracts out, so to say. What we still have to build for many of those use cases is the backend and a user interface. In the mid-long term, we're already thinking out in Arcadia V2. So basically a whole new set of smart contracts that will offer similar features, but better. So some new things we're already working on, or on the drawing board at least, is real cross-chain margin accounts, so that users can open a margin account on mainnet and on an L2, for instance, deposit assets as collateral in their margin account on mainnet, which can be assets that are hard to bridge, like DeFi positions or NFTs, and then use the assets in the margin account on mainnet to open financial positions on a layer 2. More and more financial positions are becoming more gas intensive, so it makes sense to those on layer 2. So that's one of the additional things we're working on for a V2. Another one is partial liquidations. So if you have an unhealthy position or a position at risk of becoming unhealthy, that is partially liquidated and not fully as today. And also no risk model, building out a lot of added features. So that's, let's say, the mid-long term. And then really in the long term, we really want to go to margin accounts as you know them from traditional finance. So all the use cases now are basically leverage strategies where you borrow from our own liquidity pools, but the margin accounts can actually do much more. As said, any DeFi protocol where counterparty risks have to be managed can build on top of our margin accounts. So for instance, future protocols or option protocols can also use an Arcadia margin account, and that's in the long term. What we build is that the margin accounts are really a DeFi building block on top of which multiple protocols build. So that's short, middle, and long-term roadmap.
Yeah, very cool. I mean, I think I don't expect this was the use case you guys were going for, but it makes me really excited to start LPing some of my shitcoins on mainnet.
Be my guess, yes.
So very cool. So are there any particular dates that people should be keeping an eye on for future rollouts?
Maybe not particular dates, but we will continuously ship additional features. So I think best is to follow our Twitter or join our Discord, and then every 2-3 weeks we will give an update of new use cases or some new features for users. So yeah, many of them will be more front-end related features. But yeah, best to keep there. Maybe a last one is some use cases are already live. So today you can already trade or you can already build some leveraged strategies. Maybe a nice insight that is currently there's quite a big spread between the yield that Coinbase Stake ETH and Wrapped Stake ETH yield against our current lending rates. So there's a spread of around 3%. So for the listeners, that might be some nice alpha to go build your leveraged yield farming pool.
Yeah, very cool. Well, good. So now we should probably open it up to questions. While everybody thinks of their questions, do you guys have any closing remarks? Anything we missed? And everybody in the audience, please raise your hand or tweet at us or come to DeFi Raiders Discord and chat at me. But super exciting protocol. I'm excited to go check it out and use it and see what you guys build on top of it, or
Yes,
how you
yes,
enhance
thanks
it
a lot.
perhaps better.
Yeah, also our dev is a week live. We know we still have some work on the design and user experience. So we're really happy for any feedback on what we can improve. That's really the goal of this phase now. It's still with the quite capped pools and deposit limits. So we really want to get as much feedback as possible. Also, thanks for having us here today and great questions. I think you really understand what we're building and where we want to go. So thanks again.
Yeah, my pleasure. Thanks so much for joining. Again, this is I love talking to to teams that are building things that are unique, and this is like strongly unique.
Thanks. It's definitely a compliment.
So anyway, any questions from the audience? Any other closing remarks? Otherwise, I think we might be ready to wrap it up. Going twice. All right. Thanks everybody for attending another DeFi Raiders AMA. I've been Degenic here with the Arcadia finance team. And yeah, we're super excited to see their continued rollout of features and full platform in the next couple of weeks.